Welcome to The Explainer. Today, we're tearing down some major illusions about the financial markets. Look, this isn't a guide on how to buy luxury cars, and it's certainly not a manual for getting rich overnight. Instead, consider this your mandatory manual for survival in the markets. We are talking about risk management, the real secret sauce that separates seasoned professionals from gamblers.
Okay, let's dive into this. Here's our roadmap. We'll start with the trading failure myth, move through 4 non-negotiable risk management rules, and finally wrap up with surviving to profitability. Section 1, the trading failure myth. Before we get to the rules of survival, we really have to face reality. Why do most traders actually fail? You probably spend hours analyzing charts, backtesting setups, and hunting for that holy grail strategy, but accounts still go to zero. So what's the deal? Well, the truth is, most traders fail not because of a flawed strategy, but because of poor risk management. It's not your entry trigger that's the fatal flaw. It's the complete lack of defense once you're actually in the market. A mediocre strategy with incredible risk management will outperform a genius strategy with zero risk management every single time. So here are 4 powerful risk management strategies every trader absolutely needs to know. First up, Section 2. Rule 1. Fixed percentage risk. Now, what's really interesting here is how this small, strict percentage is the key to managing your account on each and every trade. Risk only 1% or 2% of your account on each trade. It sounds tiny, right? Almost too small to make big profits. But setting this strict, emotionless boundary is the absolute bedrock of preserving your capital over the long haul. Because this protects your capital during losing streaks. And let's be real, losing streaks are mathematically inevitable. Even the absolute best systems in the world experience painful drawdowns. But if you only risk 1% and lose 10 times in a row, your account isn't destroyed. You still have the vast majority of your capital left to step back, reassess, and fight another day. Second, Section 3, Rule 2, Stop-Loss-Based Risk Management. We are elevating this concept from a mere suggestion to an uncompromising requirement. Always decide your stop-loss before entering a trade and adjust your lot size accordingly. You absolutely must know your exact downside before you ever click that buy or sell button. Never trade without a stop-loss. Operating in the financial markets without one is exactly like driving a sports car without brakes. It might feel fast and exciting for a little while, but eventually you are guaranteed to crash. Third, Section 4, Rule 3, Risk-Reward Ratio. Let's move to and see how this builds. We spent a lot of time talking about capping our losses. Now we need to optimize our potential gains. The core premise here is super straightforward. Take trades where the reward is bigger than the risk. Your potential upside just has to heavily outweigh your defined downside. And this brilliantly illustrates the math behind it. For example, risking 1 to make 2 mathematically stacks the odds in your favor. If you routinely follow this ratio, the math gets incredibly forgiving. You don't even need to be right 50% of the time to make a profit. You can literally be wrong more often than you're right, and your account will still grow. Fourth, Section 5, Rule 4, Asset Diversification. Up until now, we've been managing micro risk on individual trades. Now, let's zoom out. Don't put all your money into one trade or one asset. Spread your investment across different assets to reduce overall risk. Because no matter how convinced you are of a setup, the market can and will do the unexpected. If one asset tanks, the others keep your portfolio afloat. Finally, Section 6, Surviving to Profitability. Let's drop the pace for a second and look at the bigger, philosophical picture of what it actually takes to succeed. Remember, trading is not about making money fast. We have to completely shatter the illusion of glamorous, overnight wealth. The markets are unforgiving, and the people trying to get rich quick, they're the exact same ones supplying the liquidity and profits for disciplined professionals. So, the crucial point is that adhering to these 4 strategies serves one singular purpose. It's about protecting your capital and surviving long enough to become consistently profitable. In trading, survival absolutely must precede success. Which leaves us with this final gut check question. Are you trying to get rich quick or survive long enough to win? I want you to really think about your core motivations the next time you sit down at your charts. Let the math, not your emotions, dictate your actions. That is our explainer on risk management for today. Keep this survival guide close, stay focused, and keep learning.